From October 2006 to March 2007, there was a less common formation that is the opposite situation to what was seen from May to August 2017 on chart pattern example case study 58 with the MasterCard stock chart. A horizontally flipped triangle outline provides bullish context to continue the established uptrend. It also shares a base of support with a small double bottom in March. This solid continuation progresses the larger uptrend and is a factor in reducing the impact of the triple top reversal that follows. As McDonald's stock develops a wide range at newer highs, the old triple top range becomes a natural lower boundary, where several volatile upswings take place. The new decade begins with a bullish continuation to finally break out of the prolonged phase of horizontal trading. This would have been a less stable bullish continuation if it were not for the ascending triangle that ended the horizontal resting phase range of a regular bullish continuation outline. The uptrend line on the chart is based on the exact incline of the upswings within the ascending triangle, which is why the inclines before and after the triangle completed were approximately but not precisely on the same trajectory. A few years later, there is another extended period of range-bound trading that ends with a much less sustainable incline on a much steeper trajectory. As expected, the steep incline is not sustained in the long term, and even though the longer-term uptrend line is still intact, there are sharper and more frequent corrections compared to the steady climb following the ascending triangle from 2010. Interestingly, the rapid moderate corrections also include a failed head and shoulders. A failed double bottom range is followed by 3 methods falling price action into October that eventually leads to a bearish overextension in the short term. The 113 level now marks the upper boundary of a new double bottom range. The 113 level also marks a minor gap up level in October. Now here is the exact opposite, with 3 methods rising price action completing a successful double bottom to firmly establish over 113. As the uptrend steadily rises, a failed head and shoulders crosses the old downtrend line and demonstrates the characteristic incline with the right shoulder that is commonly seen with failed head and shoulders. It would have been a stretch to say late 2015 to late 2016 had the outline of a head and shoulders that failed, though there are the characteristics of the gradual transition from an uptrend to a downtrend, and the 113 to 110 range was a crucial range of long-term support that just happened to be a gap-up range, which was not immediately filled, to demonstrate the general strength of the larger uptrend continuation. The long-term uptrend line appears with residual influence as it crosses near the solid 182.30 level that marks the neckline of a strict head and shoulders pattern. Later, there is a regular downswing in late January 2019 with a large bearish engulfing candle pattern. This is to be expected since the old head and shoulders range provides stronger resistance potential. A steady uptrend develops following the February drop that didn't directly fall back onto 170.80. Despite these developments, the old head and shoulders range still presents firm resistance to slow down a more rapid rise to newer highs. Interestingly, here is a case where a strict head and shoulders and ascending triangle overlap. The head and shoulders is a minor correction in the long term, as seen by its relatively small imprint on the chart, when compared to the ascending triangle, that even has a slightly more aggressive internal uptrend to finish relatively early. The uptrend is still stable as regular spikes of bearish volume form small corrections. When a more substantial correction forms, the lower uptrend line and, more importantly, the upper 190 to 188 range halt an aggressive downtrend that is bearishly exhausted, to begin November after spiking down with a small gap down. The bearish reversal stems from a flatter variation of a strict head and shoulders outline that comprises horizontal ranges with more than just 3 downswings in total, like a regular head and shoulders. In fact, the upper range forms a flat top, with 4 minor downswings to form the head for additional bearish context. Price action is neatly contained within the outline, that even sees a noticeable decline with the right shoulder, for more valid downtrend lines that still slow down the gradual recovery. In fact, the right shoulder is a descending triangle. Back at the old head and shoulders range, there is another small head and shoulders reusing the same levels. But it would have been more difficult to spot during and even after its development for some market participants due to its compact outline and increased volatility that followed the break of the neckline range. The downtrend lines from the prior head and shoulders demonstrate further volatility as they and an old uptrend line highlight the approximate area of greater support potential. When the volatile drop begins to slow, the 190 to 188 range is extra influential due to being part of the last major bullish pattern that was the ascending triangle. The sharp drop is another good reminder that even strong support from highly valid patterns can be breached, but can still provide temporary support in slowing down the downtrend. The period from April to June also demonstrates the utility of trend lines from patterns, as there is prolonged resistance prior to the eventual return above 190 and the formation of a new ascending triangle. In this case, it would have been helpful to more broadly define the upper boundary of the new ascending triangle to include the 209 to 206 range, as it was an obvious area of relevant resistance from being the neckline range of the past 2 head and shoulders.